Happy Wednesday to you as we talk about growth and value stocks. My name is James Boyd. Kevin Horner's in the chat. Say hello, Kevin. We also got with us Ket Line, Paul Farley, Will Tuner, 7712. We also have with us Life in the Fast Lane, BJ, Silas, and many others. Good morning to all. And just real quick reminder, this class is being recorded. You could actually also go to this page, and this is our page right on YouTube. Quick reminder that if you're not on a computer, it doesn't mean you can't watch the session. You can just pull up YouTube on your phone, on your iPad, or whatever you have, okay? Samsung users, tablet, whatever you want to call it. Our page on YouTube is Trader Talk Schwab Coaching Webcast, okay? If you have not subscribed, you could actually do so right in the middle of the page. You're going to see our playlist right there. You could also search our content right there as well. Now, also, the playlist for this class, which I sent out earlier, just want to make sure you have that, is right there. Now, last week we talked about our semiconductors stocks on potential sale. We'll talk about that actually here today and maybe some management of that today. Want to look at SanDisk for sure, okay, WDC, and maybe Intel if we have a little time. Now, also just real quick as we get started, remember that Kevin and I do post educational content on X. There's my handle. Kevin will post his handle in the chat. That way you can click on it and follow Kevin as well. Want to give us a quick reminder that with what we discussed, the information I talk about is done for general informational purposes only. Should not be considered an individualized recommendation. Schwab does not recommend the use of technical analysis as a sole means of research. The paid money software application is provided for educational purposes only. When we talk about examples and demonstrating trades, understand that we're taking risk, including loss of principal. Without taking risk, there's no reward, okay? So sometimes the bigger the risk, maybe the potential bigger reward, right? And so the biggest thing is we need to get comfortable with how much are we going to invest? What is the potential risk? What could go wrong? If we also bring up, let's say, dividend paying stocks, understand that these are not like fixed income products. The company may reduce or stop paying dividends, okay? May also increase the dividend, maybe even give a special dividend. More of the story, we don't know what that policy is going to be in the future. Now, what I want to do is let's kind of talk about where the markets are first. And I want to kind of talk about some interesting developments we've seen so far here today. There's been some movement, okay? Now, if I were to ask you just a quick question, where's that movement been? Let me just start with just real quick the SPX. Let's start here. Now, as of yesterday, we talked about the market. When I say the market, I'm talking about the S&P 500, where the market, the S&P 500 was below both of its moving averages. Today, we're trying to push back to the upside. It's not unusual that if you actually have, let's say, a bull flag pull, which we actually had from this area where we ran to the upside, it's not unusual to maybe get a week or two flag type of pullback. It's not unusual at all, okay? Here we are. If we look at kind of see where we are, oh my gosh, we've actually had a bear market off the top. Maybe not, but that's what our friend said that doesn't know what he's talking about. And if we actually take a look at this, we pulled back a whopping 0.9%. That's it. That was the pullback from the high price down to where we currently are. Yep, 0.9% off the high. Now, what was that high to low? Okay, 1.64% from high to low. That's a very thin pullback so far for the S&P 500. Now, if we look at these names, now we know the S&P 500 is top-heavy technology. We've been saying for weeks, maybe months, go look at that equal weight. And if you look at the equal weight, this is really now telling the broad story, not just technology. You look at the equal weight S&P 500, that's a brand new high. What does that tell us? Something outside technology is moving. How many of you saw that here this morning? Please tell me you saw that. Dean, tell me you saw Coca-Cola. Now, if we actually take a look. Now, when we talk about also some of these others, such as, let's bring this up, okay? The percent of S&P 500 companies above their 200-day moving average, 73.69%. That's a brand new high, okay? If we take a look at, let's say, the 50-period moving average, we didn't see that really change. but it was really in the 200 period moving average. If I took if I did the 100 period moving average, okay, that's not really going to change. It topped out about 75%. And if I did this, let me double check. Yeah. So we got the 50, the 100, and the 200. And that, if we go back to, let's say, the 100, we're still right at pretty much still hitting right around 70%. Now, some of the things we brought up, okay, that was, I mean, right off the start, when you're doing kind of like what's happening in the market, you wake up. I mean, it would have been pretty impossible not to see the 100-point smash on gold this morning. Now, yesterday, kind of we're joking. James always likes to buy at the highs or up near an area of resistance. I talk about the reasons why. Okay. Remember, if you're making higher lows going into resistance, that resistance might be jello. Okay. It's probably not as strong as you think it is. Okay. Especially if we're making higher lows and we have some tailwinds. Some of the tailwinds, if we're talking about commodities, would be the US peso. I mean, dollar. That US dollar this morning took not just a little leg down, took a drop kick, okay, to the downside. You don't wake up and see down 0.75% on the dollar basket here, okay? So the US dollar moving down. Now remember, think teeter-totter, okay? Same thing. If the US dollar actually goes down, what counters that? Well, commodities, right? Could. Well, it could be gold. It could be silver. It could be palladium, platinum. It could be oil. Okay? Now, if we actually said, oh, now we're too late. We're too late. If you think that, you really haven't listened to the things I've been talking about in the last week and a half. Okay? Go back and re-listen to buying stocks at highs. Now, if we take a look at crude oil, which we haven't looked at yesterday so far, we talked about maybe is crude oil maybe starting to get above its diagonal slant. Does it have the likelihood of maybe going up to, let's say, 92, up to the area of, let's say, 105, etc.? We might think, oh, yeah, it's already had its move. It's already done. We know nothing about trends if we actually say that. Absolutely nothing. You're looking at the price and you're making the decision and you're not looking at the trend. Okay? Now, James, why are you hitting so hard on this today? It's only 7 minutes in. Aren't we all friends? We are. But I sure hope it doesn't take you as long as it took me to understand. Okay? Trends are powerful. Okay? Once that train gets going, choo, a lot of times, a lot higher than we think. Now, if we take a look at one area that has not done that great, which we're going to have to bring up, is semis, which showed a cross yesterday and today. VIX actually falling back down, slightly down to about 15. Rates slightly down here today. Now, that might help some of these areas, okay? But that was actually almost at a brand new high yesterday. And so when we kind of talk about, we got dollar bearishness, which might be commodity bullishness, think base materials, energy, stocks, etc. When I say base materials, think precious metals. Rates actually drop, could push up stock prices. Semis affecting obviously the semiconductors, some technology stocks, sure, NASDAQ. But that volatility staying somewhat sedated at 15 probably tells us there's some trends are holding up somewhere. Probably the biggest takeaway, gold, keep an eye on actually crude oil, but probably the biggest takeaway is holy Toledo on the equal weight. Okay, now let's bring up some of these names for just a moment. Okay, so are you sitting down? I want you to grab. Okay, now a lot of times people say buying sectors is boring. Okay, well maybe the investor just doesn't buy that many shares. Okay. So now if we bring up, let's say, healthcare, make sure both hands are grabbing the seat of your chair. Healthcare, when's the last time you saw a big 3%? And we talked about these yesterday. And so if you look at healthcare, I mean, were you watching any of those in healthcare? Okay. And remember, some people say healthcare is boring. Again, maybe it goes back to, are they buying a number of shares? I mean, what if you bought 300 shares, 400 shares, 500 shares? You don't have to have big movements. Maybe it's just the shares that you're buying. Healthcare getting a push. Wordy brought up gold. Okay. The biggest actually thing about gold, which we'll talk about, kind of has now that door opened up, let's say about 6-7% up to the next level resistance if it can get there. Look at AM, NEM, pretty good push here today. Now remember, the investor might not buy the individual stocks; they might buy the group in general. Discretionaries had a decent push here today, helped by what stock? What stock? That's right, yours truly, Apple. Is it for real? Is that double bottom really in? Okay, we'll bring that up in just a second. Staples. Now, Staples has kind of been grinding. Okay. Now, if we looked at Staples, we would say, yeah, it has done a whole lot. The biggest thing you got to remember is Staples, when technology actually goes down, that's when these areas tend to pick up. So they tend to underperform if the market is more growth oriented. But when the growth drops, let's say technology, these areas tend to push. Now, again, it goes back to how many shares did the investor buy? Okay. If we bought 25 shares, that's why it doesn't really feel like it's impactful. Wonder if you bought 300 shares. Okay. Now, if we go back to communication, not so much. Transport, not as much. Okay. The one area that we would say to keep an eye on in the transports is railroads. Okay. Especially if we get oil to actually go up. Maybe they don't truck as much. Maybe they rail those items. Okay. UNP, NSC, CSX, and so on. If we look at energy, doink. Okay. Now remember, it's not about getting all the trades right. We're not looking at how this one trade did. We're thinking about the basket of trades. But if we're talking about a crossover and moving averages, green, price predominantly staying above the 10-period moving average, and we only had one down day in this thrust to the upside, pretty good move. We can't complain here, okay? Now, if we look at, let's say, also the real estate, that, okay, kind of stuck a little bit. Financials, okay, neutral a little bit. And utilities, let's bring those up. Now, utilities underperform. So you're going to notice that kind of utilities and real estate more sensitive to interest rates. They've underperformed. Okay, now let's take a look at this. Okay, a couple of names. We got so much to do. Now let me kind of just go to the Dow Jones. Okay, just really quick. So let's imagine we just wake up, market opens, ding, 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 ding. What's right on the very top? Merck Healthcare, Amgen Healthcare. Okay. And if we look at, let's say, the Merck, we're going to take a look at that. And that was actually a pretty big push. Now, I want to go back to the paper money account. And I want to double check. Did Merck, there it is right there. Blind squirrel finds a nut every once in a while, eventually. Decent. 134.65, 149.90. Now, 685. 685, you might say, is chump change, but you got to remember, $686 is a 1% move on the account value on that 145 shares purchased last week. Now, if we take a quick look at this for just a moment, I just want to make sure we're not like falling into a trap. What's the trap? Well, tell me what that trap might be. Now, we're so stoked on the big pop. But like when we go back to the moving average envelopes, is there anything that you might consider? Well, some investors might say, James, with today's pop, yeah, it's great. It helped the position out, but it's popped to the blue line, and that dark blue line, or navy, is 10% above the 10-day exponential moving average. Some investors, if they do get pops like that, they might decide to sell some of the position or sell all of the position. Now, just because they sell the position today doesn't mean they can't buy, let's say, in a week from now. Now, what would you do? If this was your trade, what would you do? Well, some investors might say, James, how frequent do we actually get to that? Well, we got to that right there. We got to that right there. 2 times it actually pulled back. And so out of the last year, we hit the blue line and we pulled back both times. Now, Eric says you're absolutely nuts not to take profit. Now, Eric didn't say that. He's so nice. Okay. But some of you actually might say, James, take some profits. How do you sell something? Okay. Well, let's actually go back into this. How do we do that? We're going to right click on that, create closing order. Now, I want you to think about, so it's the gain on that position about $706. This was in a week. Okay. So in 1 week, this stock position, 45 shares, moved the portfolio value 1% by itself, not leverage, just shares. Not 400 shares, 45 shares. That's a decent push for just a share in a week. Now, if we go to create closing order, sell, we're just going to sell those shares. If we sell those shares, we got to actually go sell. Let's see what the order is. I'm going to cancel that. And now when we actually do that, right click on that, create closing order. There's not any pending orders. Sell those shares of Merck. Well, why are we selling? Why? We're selling those shares because it's popped to the 10% line. And this is when you have probably a greater chance of the stock flagging back or pulling back. This is not to say that we can't look at it in a couple days and try to re-enter on a bounce. If you had a high, the greatest chance is actually to make a higher low. Okay? A high is not bearish. The high might be, let's say, short-term profit opportunity. Okay? Especially if it gets that far elevated on a percentile basis off the moving average. Now, this is consistent with what we've talked about. That's what we've had the moving average envelopes in the package of charts. We're going to go to actually mid, confirm send the order. Now, do not assume that the order fills. We want to make sure that that actually goes to zero. It does. We took the profit. As Hannah would say, spank you very much. Now, if we actually go back to the other one just real quick, which we talked about yesterday, Apple. Now, let's go back to where it was yesterday. What were we seeing yesterday that said, maybe this is starting to turn bullish again? Now, here's the deal. A lot of times, okay, the first time that we actually had this stock kind of show us maybe a higher high, it didn't really materialize, okay, for about the next week and a half. It did. What I've seen is sometimes if that first breakout doesn't really materialize, that does not mean that the next one can't. Now, what's the problem? The problem is, as people, we have memory. As people, we have emotion. And so now when we see the stock doing something like this, we're thinking, yeah, last time didn't work. And what does the last time have to do with now? Do you think the market remembers that Jay Richardson or James Boyd got their feelings hurt on that last time? They don't even know our names. Okay, so just having a little fun with everyone. Has anyone ever done that, just taking it personally, besides me? Now, so yesterday, this is what we saw. Kind of maybe like a little double bottom. Uno, dos, okay? And you see kind of a little double bottom. We talked about that speculation. Maybe as far as what those product announcements could be, maybe right around the 8th or 9th, potentially, of September. Today, doink. And that doink actually got above the middle of what we call the W. Oh, you're so lucky. I don't know. I mean, you take an entry, you don't know what's going to happen. So far, it's kind of working out. So far, okay? We don't know anything past that right edge. What we do see now is kind of the gap where we actually fell down to there. This gap, if we kind of said, what's the range of what we're talking about now? Well, that range from where we gap down from to where we gap down to, okay, that's where we're looking at, that range. And now if we kind of said, what's the midsection of that range? The middle, 322, and the top of that range, 333. Now, the average investor would say, man, I'm going to go look for another stock. And the person that has experience said, another stock? What's wrong with this one? Now, this is what people call dollar cost averaging. They might say, hey, I have a kind of a bounce. I have a breakout. Now, the investor might say, well, James, has it moved up too much? Well, let's go check. Okay. Where are we? Oh, this is funny. Okay. This is funny. Now, we were sitting the fanny of the candle this morning was sitting right on the 10-period moving average just this morning, 90 minutes ago. 90 minutes ago. And then we think it's so high because it's up $8. But you got to remember, it's $8 on a $310 stock, which accounts for 2.8%. We're not even at the 3% line yet. Now, trade number one. Now, we did Merck. We closed that. Trade number one is going to be adding to the position of Apple. Now, James, when you say adding to, what is in the paper money count? Well, we got 43 shares right there, okay? I'm going to try to go to the IRA and say, is there any there? We got a little bit right there. Now, it's not as much shares. We're going to come into the IRA, right-click, buy custom with OCO bracket. Now, if we do this, if we do a bracket trade, okay, so we're at 169,258. If we took, let's say, 5%, no more than 8% of the capital, which is what we said at the end of last year, we're going to take, I'll just do 5%, okay? 169,299, 5% of that. It's going to give us a budget of $8,400. All right, now, I'm going to go down to this right here, the pool balls, percent, dollar amount. We're going to type in that budget of $8,400, okay? How many shares is it going to be? About 26 shares. Now, when we actually go back to that Target, God, did you see that target this morning? That was pretty interesting. Speaking of Target, I'm going to put that actually number at about 333, okay? The stop underneath, I'm going to put it underneath the moving average, the whole moving average, okay? Now, if we look at this, we got about 308.26. You watching this? You paying attention? Okay. 302.09. So now when I actually come down here, 302.09. Now, there might be a question upon, hey, could we run these numbers so we can kind of see that on a percentage wise? When we saw the moving average envelopes, it would lead us to believe that it's probably not that, it's not that much on a percentage basis. So I'll show you. If we look at this just really quick, I'm going to go and see where's that moving average again. It's at 308.10-ish. Stop. I'd put, we're off 15 cents. 301.94. The risk in dollars is 16. The percentage is 5. Okay. Not that surprising because we were at the yellow moving average envelope. Okay. So think we were 3% above the 10-day moving average. And if the stop is 2% below, that's going to be right around 5. So not a real surprise. Now what I'm going to do is go data GTC. Remember that stop is saying if we go down to that price or less, okay, sell the shares of stock. All right. So the bad part is we don't know what it's going to fill at. You sure hope that it doesn't gap down and it gets filled at a substantially lower price. Okay. Now I'm going to go confirm and send. So trade number one was Apple. Send the order. We're going to see if it fills. There. Okay. Now that order is sitting right there. It moved a little bit on us. And that order is sitting at 318.64. There it is. We see it fill. There's the stop. There's the target. Now, let's go back to an example we did last week when we talked about semiconductors. We did the example of SanDisk. Okay, now, this has been an interesting ride. Okay, now SanDisk last week was purchased at $13.78. Okay, so that was last week in this class, literally at 9:20 my time. Okay, literally 1 week ago. Okay. So let's bring up SanDisk. Let's talk about this. Should we stay or should we go? Now, this is interesting, and I didn't go back and check. We had a target on this right around 1794. We moved up the target, I think, last Thursday. For some reason, it didn't fill. And I didn't move. We moved up the target, and then on I think it was Monday, it overshot that target for some reason, which I don't know why. It paid money, it didn't fill. So that gain on those 4 shares of stock, we should have had a gain. It was 190. The gain should have been $800 more than where it is now. Okay. Okay. So first off, we'd say that maybe a paper money glitch. We overshot the target. That should have been about a $1,700 gain in about 4 days on 4 shares of stock. Okay, of SanDisk. Here we are now. Now, if we take a look at this, what are we going to do? Let's say it didn't fill. Okay, here we are now. What's the plan? Well, one of the things we don't like on SanDisk, remember we talked about higher lows? That's a higher low. Now, by the way, no one else teaches this the way I teach it. Okay, most people are trend traders. I'm a momentum trader. Okay, so when we actually look at momentum, we're looking at that. We're looking at this. We're looking at that. The higher lows is the red and green candle side by side. We draw the line from the open of the green candle. Now, that's a marker that we're watching. Can we stay above that? This is a marker. Can we stay above that? This is also a marker. Can we stay above that? The negative part about this case of SanDisk is we've closed 2 times now below the higher low. The higher low is like a shorter term support level for momentum traders. Now, for trend traders, they say if we break below support, I want to maybe get out. For a momentum trader who's trading growth, they might say if we trade below that higher low marker, which can act like short-term support level, I want to get out or I want to move up my stop. Well, what we're going to do is we're just going to manually eject. Now, James, don't you feel upset that the gain should have been like $1,750? No, this is paper money. Okay. I mean, do I feel upset about paper money? No, I don't feel upset about it. Should have filled though. Okay. But if we're kind of going in there now and saying, okay, now what we're going to do is cancel that order. If we cancel the target, we cancel the stop. And that's kind of unusual that it should unhook both. And now what I'm going to do is going to go into SanDisk. Why are we selling SanDisk? Right click on that. Because I said that stock in the short term closed and traded and closed below the higher low, which can act like support. Repeat. When you're trading a stock with momentum, growth, stocks especially, the higher low markers are your green and red candles side by side. The red candles are where we stopped going down. The green candles are where we started going up. We draw the line from the open of the green candle, the body of the green candle. And that held. It was beautiful. And down the stretch it comes. That's what it was like, $1,750 in 4 trading days on 4 shares. $1,750 on an account that was at $61,000. That one position moved the account 2.7% in 4 trading days. Now, I know someone's going to say, well, I heard some guy on the internet made 20%. Look, I have no clue. I have no clue what that person did. The biggest actually thing is if we can get these trades to move the account, maybe 1% on each one, and maybe over time we might be consistent, you're thinking maybe the account balance might appreciate. Might. Now, we don't know. That's why we trade daily. We at least look for them. Now, so Merck we actually exited. SanDisk we exited. Merck was way off support. SanDisk was actually a breach below the support level. Now, let's actually go back to another trade example. Now, what I want to do is yesterday. So when we talked about, for example, healthcare, did anyone go out yesterday and look at a couple of healthcare stocks? Now, type those in the chat, okay? Now, there was a couple names like, that was like Amgen, okay? Amgen was getting a little push. Amgen was pretty consistent. Amgen hit a brand new high here today. We also see a stock like GEHC, GE Healthcare, that is kind of maybe showing a cup. The rim of the cup is right here, okay? Now remember, when we talk about rims of cups, there's a base here, and that base It's right about there with the kind of the width. That's about $13 or 22%. $13, 22%. $13 is going to get us to about right about there. Okay. Now it's kind of funny how sometimes these stocks can kind of play in these inside these previous ranges right there. Now I might come back to that in just a second. But that's one that has not really flagged a whole lot back from the rally to the upside. Let me zoom in on this right-hand side. So what I'm going to do is I'm going to be the hammer and the chart is going to be the nail, okay? Notice that we have 2 days down and then we go right back up. 2 days down and then we go right back up. 3 days down. When I say days down, I'm talking about the red candles. Now, when we see something where the red candles are less than 3, we think of the big choo-choo name called momentum. Now, just like I talked about before, how do we see those higher lows? Well, let's go back to it. I think these things are right on the chart, but we're not trained to see it. Not yet. I'm coming for you. Now, if we take a look at this, you're now going to see that if we circle the red and green candle side by side, and we draw the line from the open, you're now going to see on the chart, there's the higher low, which we actually did not close below. If we traded below, it didn't stay for very long, probably wouldn't have stopped us out. There's another higher low, and give us another one. So we now see where these higher lows on the chart, where those shorter term type of traders could be trying to trade that momentum. Now, if the investor says, yeah, but we're up too high. Now, I want you to imagine that the brokerage account of somebody today hit $1 million, 7 figures, or they hit $10 million. And then you told that person, man, you should sell everything because your account hit a brand new high and you should just sell everything. I mean, it's just unusual when you really speak out what you're thinking. Okay? Now, if we take a look at this, what we're going to kind of show in this case is, what if I said, I don't think it could go up to $13. Maybe I think it's maybe a little bit less. Maybe I said it's $83. So what I'm going to do is on this right-hand side is we're going to buy the shares of GEHC. Right-click, buy custom with OCO bracket. Now, does the investor, do they have to set the stop below that first higher low? They don't have to. But if they're trading the momentum, that's probably where they'd set that stop. Underneath that 73.40, less 2 to 3%. But if the investor said, look, I want to try to give it a little bit more wiggle room just in case, probably the secondary support level, 2 to 3% underneath 70.30. We're going to go to the paper money account. Going to go right back to the margin account, GEHC. And now what we're going to do is we're going to right click on that chart in the paper money account, buy custom with OCO bracket, and we're going to put those numbers, okay, back this off. That number, if we said, where do we kind of think that horizontal resistance is? Now, some of you might be saying, James, I'm not even that high. I'm at 79. I'm in an area, let's say 83-ish, okay? Those might be 2 markers for support. All right, now, what I'm going to do is I'm going to put a number of, let's say, $83. Data GTC. Now, if you said to me, James, I don't like tight stops, I'm going to set mine a little looser. Now, everyone, when they first get started investing, we learn about reward to risk. Reward to risk, I mean, you could have big rewards and tight stops and you think they're sweet trades. The problem is you're not really looking at the probabilities of those prices being hit. We set tight stops, we got a greater chance on getting stopped out. But the reward was big. Some investors over experience say, I don't want tight stops. I don't want to be nicked out only to see it go right back up and smash the target. I just locked in the loss. That doesn't sound like fun. So maybe the investor says, you know what? I'd rather set a looser stop And I'm going to set the stop underneath that 70.32, the second support area. Now, it's up to you. Okay. You watching? Okay. 70.32, less 2%, 68.91. Now, when we go into this, we know that how that stop works. We're saying if it goes to that price or less, sell those shares. Now, the way this is probably rude is it gaps down hard. Let's say it gaps down to 62. That fill could be even worse. Now, what we might do is we could say stop limit, and that's actually saying, here's my stop, and you could place, look, I need to be sold in a range, okay? I'm not going to go down that path, but just know there's a way you could do that. The con about that is the risk is it could keep going down, okay? So what we're going to do is we're going to take 68.91, target 83, and we actually come back to the capital in that account. It's going to be about $62,000, 6,200, excuse me, of capital if we take 10% of this account value. Now I'm going to go confirm and send. Okay. Target, stop. Now, Bill actually says GEHC is 3% over the SMA. Now, is that bad? I mean, what? So let's say Bill says that. What do we take from that? Okay. So first thing we have to understand is if we're going to get a close above the high of the low day, like here, we got to get the price to go up. What does that mean? It means that it's further off the aqua or light blue line. So to get a bounce or a breakout, the price has to go up. So if we look at the one hold, it was at the 5% line. It was a little bit more elevated. Horrible? No. More elevated? Yeah, a little bit more. Well, when's the next time it had another hold? Right here. It was right about 5% again, maybe a high 4%. Okay? Well, what about now? Well, what you're going to see now, we're at the yellow line. The last two times we had hold, 5%, 5%, okay? 3%. So, kind of, when we take a look at this, it's just not as elevated as it was before, okay? Now, remember, we have to understand something. If we're going to get a bounce setup, it's unlikely, unless you're buying right off the moving averages, that you're going to say, oh man, I got in a quarter off the moving average, because that's not much of a bounce, okay? So to see the stock go down to the moving average and then bounce back up, the price has to go up. Now, what some investors might do is they might say, James, I sure hope, okay, that I get a nice bounce, maybe no higher than 3%. We're barely above that, okay? Now, does that guarantee the stock's going to go up? No, it's just showing how far we're above the moving average. Why does that matter? Well, because they might be setting the stop underneath the moving average. All right. No, I think Bill, I just want to kind of say, you said what you said, right? What does that really mean? Let's go back and look at the last times when we actually got bullish bounce setups. How does it relate? So I thought your point was fair. Okay. Now, also, just real quick, if we go back to, now, I want to kind of, why do I always want to have fun with Pia a little bit? I feel like, now, Pia, did she lead us down a dirty, dusty road here? When Pia talked, we talked about energy, and we said, obviously, if we say energy, the investor might say the sector, okay? When we talk about energy, two names, integrated names, would be Chevron, that holy cow. Exxon. Okay. Now, if you look at Exxon, we need to talk about Exxon. Okay. Now, we kind of sit Pia throughout Exxon. Okay. Now, if we take a look at this, Exxon Mobil's right here, 77 shares. Now, when was that purchased? Well, which time? Okay. If we went back about 9 days ago, we purchased some at 158. We purchased some on 8/17 2 days ago. And the next one, well, actually, it was just purchased twice. Okay. So what you're now going to see is, now this is what we call dollar cost averaging. I like to think of it as we're dating the stock. Okay. So, in other words, now in dating, you say, look, if I like the person, I'll go on a second date. Okay. Well, in this case, you're saying, hey, I like that setup and I'll buy some. So you're not fully going all in on the capital, but you're like, oh, look, I'm interested. Take me on that second date. Show me more trend. Show me more trend. I'll show you more money. The investor sees another bounce or breakout setup, and they add a little bit more. That second little date there, if you will, or that second bounce, second breakout. That third time you actually go out, you say, look, show me more uptrend, I'll show you more money. Now, there's limits to this, right? This is not putting the whole portfolio in. The reason why I bring this up is I think a lot of people are kind of like they put all in or none. If you watch anything that I teach and anything that Kevin teaches, trend traders don't typically put it all in at once. They spread the capital out. If there's going to be a trend, there's probably going to be multiple entries in that upward trend. Did someone just say hallelujah? I heard someone just say hallelujah. Now, okay, now let's talk about this. Now, got a situation. What's the situation? Well, the situation in this case is we went within about how far? Well, where's the target? We can see it, 170. We went about $1.76 to the target. Now, are you watching? Okay. Now, where's the stop? It's down there at 148. Clearly, this is saying mismanagement. Okay. Now, if we go within 1, 2, 3% of the target, all of a sudden our mind is starting to think 1-to-1 reward risk ratios. 1 to 1.5. Now, this is simple math now, because if we're 1% from the high, now it doesn't matter if you were at the post office when it went to the high. It doesn't matter. Where was the high? Irregardless if you're walking your dog Jacks. Well, the high was $1.76 away, 1%. The investor might say, well, James, I'm going to take that high, set my stop 176 from or below that high. The stop is going to be moved to 166.42. Why? To not give it all back. Okay? Now, have you ever had a situation where you're like, James, I had a really nice trade. At the very end, now, by the way, who taught you this? I did. I taught myself this because I got so sick of I was right. And at the very end, it just yanks back and takes away 50, 75, 90% of the profit and leaves crumbs right at the very end. Oh, how rude. So I kind of said, well, I'm not going to try to actually risk more than I could potentially make. So if I have $1 left, I'm not going to get back more than $1. If I have $1 to make, I'm not going to risk more than $1.50. So when we get 1 to 2 to 3% away from the target, we immediately start thinking 1-to-1 reward risk ratio, 1 to 1.5. Now here's the deal. You just like you did here. You don't need some special sheet. You could say, how far did we actually get away? 1%. Ding, ding, flashing lights now. And we could say just 182, move it down to 182, and now this becomes the stop. Now, wonder if today we go up to 169.50, adjust the stop even more. Some people might do, let's say, trailing stops. You could. But the biggest actually thing is we're manually watching this and just adjusting this up. Okay, now, Greg actually says, why not 1-to-1 on Merck? I'll show you the difference. When we look at, let's say, the example of ExxonMobil, we are nowhere in the nosebleed section of the 10% envelope. When we look at Exxon, we're barely above the 3% threshold. Does that make sense? So, I'll show you again if we forgot. When you look at Merck, nosebleeds, okay? Dark blue line. ExxonMobil, okay? Not even there. So why are we going in manually and just ejecting on Merck versus letting Exxon play out. We're not extended. Okay. Now we're close to the target. And what we're doing is we're just squeezing the stops. That's why. Okay. Now, so quick stocks I just want to make mention in 30 seconds. Some stocks that we need to watch. Number one is Coca-Cola. Coca-Cola had a pretty decent bounce, little push here. Decent flag on Coca-Cola. The other one, if we're talking about growth, which we said yesterday, keep an eye on, is Netflix. That is your classic reversal. It's not an inverse head and shoulder. It's kind of an unusual V pattern that's broken above, let's say, the 75. Now, of course, when we talk about some of these other names, keep an eye on a stock like Fane. If some of these energy names continue to break to the upside and crude oil goes up higher, that resistance at 213-ish on Fane might not be the resistance. And the last one, keep an eye on some gold names and some choo-choo names, okay? Now, I'm out of my time here today. We talked about some new examples, but also managing current positions with wise selling on the spot versus stop adjustment. Now, also coming up next, I want to give us a quick reminder that that next session is going to be, okay, we go down to the date. It's going to be managing an option portfolio with Brett Morse. I want to say thanks to Kevin Horner for answering those questions in chat. And also remember that with what we discussed, it was done for example, illustrated purposes only. All investing involves risk. And today we got a real sense of how do you manage a portfolio when you actually have some stocks that popped and some of them dropped. That's what our goal was here to do today. So with that said, thanks so much. I'll be back on tomorrow at Trading the Trend. Have a great day. Take care. Bye-bye.